How much home can you afford to purchase if you make $50,000 of income using today's interest rates of 6.5%? Or maybe you're wondering, what if interest rates go down and they go down to 5%? How much home can I afford? Or maybe you're on the pessimistic side and you think rates might go higher. So what would your monthly payment look like at an 8% interest rate? Well, that's exactly what we're going to dive into in today's video. We're going to go through a couple of different payment scenarios, if you will, using an FHA loan. We're going to talk about where we are today with rates at 6.75, where we could be if interest rates went down to 5, or where we could be if interest rates went up to 7%. Now, if you're watching this going, Jeb, why are we talking FHA? Well, for one, it's because FHA is the most lenient when it comes to debt to income ratio, when it comes to down payment, and when it comes to credit scores. As many of you know, FHA will allow you to purchase with as little as a 500 credit score. But with a credit score between 500 and 579, you need to have at least 10% for the down payment. But anything above a 579 will allow you to put just 3.5% down when purchasing a home. So if you're buying a $100,000 home, that's a $3,500 payment. A $200,000 home, that's $7,000. $300,000, that's $10,500. So on and so forth. And on top of that, FHA allows you to max out on your debt to income ratio at a 57%, which is quite a bit higher than conventional financing. So in theory, you're going to be able to get approved for more home using an FHA loan than any other loan program out there, while at the same time getting away with lower credit scores and a lower down payment. Now, something I want to be clear on very early in this video is just because you meet the basic guidelines of FHA doesn't necessarily mean FHA is going to approve you. There are other guidelines that you have to meet in order to get approved for an FHA loan. So just because you have a 500 credit score and you have 10% down doesn't mean you're going to get approved. You also need to meet the work history requirements, as well as the debt to income ratio requirements, along with many others. So when you're watching this video, just realize it's for novelty purposes only. It's not meant to tell you whether or not you qualify for a loan or to use my calculations to figure out how much your monthly payment's going to be. You should always be talking to a mortgage professional, someone that can answer your questions and guide you through that process. You should never rely on somebody like me to tell you whether or not you qualify. So with that being said, if you need a referral to a top-notch mortgage professional anywhere in the country, somebody I personally know, like, and trust, do me a favor and click that referral link in the description below. So let's circle back to the reason you came to this video. How much home can you afford to purchase at today's rates at 6.75% if you make just $50,000 of income? Now, if you're wondering, Jeb, where did you get the $50,000 of income? Well, it's because I made another video similar to this a couple of months back, and there's nearly 300,000 people that have viewed that video, which made me think there's a lot of people that are interested in knowing their monthly payments when they make around $50,000 of income. And I thought it would be helpful to explain where payments are now and where they could go if rates went down, and also where they could go if rates went up. In fact, there's a lot of people sitting on the sidelines at the moment not buying a home because they believe interest rates are going to come down. So in this video, you're going to see exactly how that's going to affect your qualifications and how much you can afford. But on the flip side, there's that chance that by waiting, interest rates actually go higher, which ultimately means you'd be paying a higher monthly payment and in turn likely qualifying for less home. Now, this isn't a push to get you to go out and buy a home, but more a video making you aware of how much interest rates affect payment as well as your qualification. And also, there's another very important thing that you need to consider when thinking about waiting. There's a belief out there that by waiting, home prices are going to decline. Well, that may happen, but the only way that happens is if interest rates go up considerably from where they are at this point. And at the moment, a lot of the economists, a lot of the lead analysts out there are expecting interest rates to decline. Well, what happens to home prices as interest rates decline? Well, we likely see a pickup in buyer demand because it helps with affordability. And with that help in affordability, it's likely going to not only stabilize prices further, but likely push them up in some areas. So by interest rates coming down, yes, your monthly payment is likely going to improve, but that also means that you're likely buying less home because prices are increasing as that buyer demand comes back to the market. So just make sure, regardless of what decision you make, you're buying for the right reasons when it's the right time in your life, and not because a YouTuber out there said it's a good time to buy. So with that said, let's talk about where payments and rates are at the moment and talk about where they could go if interest rates change. Now, before we dive into that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on everything real estate related. In order to calculate how much home you can afford, we need to calculate how much income the lender will allow you to use towards your mortgage payment. Because part of figuring out how much home you can afford is figuring out your debt to income, because that's what lenders are going to use in order to tell you, yes, you're approved, or no, you're not. So with that, lenders use your gross monthly income. That's your income before any taxes are taken out. And I often have people reaching out to me going, Jeb, that's crazy. Why would the lender use it before taxes are taken out? They know taxes are taken out. Why wouldn't they just use that amount and qualify me for less? Because otherwise they're setting me up for failure. No, not necessarily. Understand that each person takes home a different amount of money based on where they're located, based on their exemptions, based on whether or not they pay into a 401k, a deferred comp, whether they have child support, alimony, whatever coming out of their check. So the easiest way for the lender to do calculations is by doing it off your gross monthly income. And this calculation is pretty easy to do when you're a wage earner, when you're a W-2 employee and you just get a paycheck every single month. Because all you have to do is take your yearly income, divide it by 12, and essentially you have your gross monthly income at that point. Where it becomes difficult is if you're self-employed like myself and you have different write-offs and your income is variable every single month. Because what happens is self-employed people say, well, I made $100,000 last year, but then after their write-offs and all of the other expenses that they factor in, sometimes they end up showing no income at all, and then they're surprised because the lender won't approve them. So just make sure when you're doing these calculations, like I said, you're working with a professional that can answer your questions, guide you through that process. Again, that link is in the description below. So the very first place we need to start is figuring out how much your debt to income ratio is. So if you make $50,000 per year, that breaks down to $4,167 per month. But here's the thing, the lender isn't going to allow you to use your entire gross monthly income towards your mortgage payment, but they are going to allow you to use a large percentage of it towards your mortgage payment. So your debt to income ratio is really based on two different calculations. One is your housing expenses by themselves. That's your top end ratio. And then your back end ratio is your housing expenses plus any other monthly debts you have. So in the case of FHA, they allow you to have a 47 back-end ratio. So 47% of your gross monthly income can go towards your housing expenses. What are your housing expenses? They're your mortgage payment. They're your property taxes. They're your homeowner's insurance, mortgage insurance, as well as any HOA that you might have on that property. All of those things are your housing expenses. So in this example, that can't be more than $1,958 per month because that's 47% of your take-home pay of $4,167. But with that said, you could have some other debts and still qualify for these numbers, but it couldn't be more than about $416 in monthly debts. And that's for things like your car payments, your credit card, your student loans. Now, if you have more than $416, these numbers aren't going to work. If you have less than that, then you're still going to get capped by that front end ratio. So in today's video, we're just going to be primarily talking about somebody that has little to no debt so that the numbers we're giving are accurate. If you have a lot of debt or no debt at all, then the calculations might change just a little bit. And also note, the higher your credit scores, the higher your down payment, the better position you're going to be in. Typically, it's going to result in a higher interest rate. But one nice thing about FHA is that the interest rate doesn't really vary much once you get to a certain credit score. Once you're above a 680, your interest rate is more or less going to be the same. The same is said for your mortgage insurance. Mortgage insurance with FHA doesn't change when you're putting that 3.5% down payment. It's the same for all borrowers. In fact, you're always going to have mortgage insurance on an FHA loan, regardless of how much you put down, with the only difference being if you put at least 10% down, the mortgage insurance will fall off after year 11. But if you put less than 10% down, you're going to have mortgage insurance on that loan for the life of that loan, with the only way to get out of it by refinancing into another loan. But that's not something we're going to talk about in today's video. We're primarily going to talk about these calculations. So let's take a look at where we are today with interest rates at 6.75%. And how I'm going to do this is basically talk about what you can qualify for with the payments that we've discussed. If you were to buy a $250,000 home, that's going to equate to an $8,750 down payment, because that's 3.5% of $250,000, which means you're going to have a base loan amount of $241,250. But here's the thing, FHA has an upfront mortgage insurance premium that you have to pay on every single FHA loan. It's 1.75% of the loan amount, and there's absolutely no way to get around it. You can pay the fee up front as part of your closing costs so that your loan amount doesn't change, but most people choose to finance it because FHA allows it. It's less money out of your pocket by doing that way, but it's also going to mean that you have less equity in the property. So even though you're putting 3.5% down, you're giving 1.75% of that back, if you will, which means you're only really going to have about 1.75% equity in that property when you close on that home. And that's one of the negatives of FHA, is that they have this upfront mortgage insurance premium, but quite frankly, it's the cost of doing business. If you only have 3.5% down and you meet the FHA guidelines and there's no other loan programs out there that you qualify for, then it's really the only option out there. But with that said, it's not necessarily a bad thing if it's your only option. So in this case, that upfront mortgage insurance premium is going to be $2,834, which means your new base loan amount that you're going to be financing is $244,084. Well, today's interest rates of 6.75% means that your mortgage payment is going to be $1,583. In addition to that, you're going to have property taxes. Now, I used 1.1% for property taxes because that's the nationwide average. In fact, it's the average where I'm located here in California as well. But if you live in an area that has high taxes, like Florida, New York, some of these other states, Texas, then you're going to have to factor in a larger property tax amount. But for today's example, we're using 1.1, which breaks down to $229 a month for property taxes. On top of that, you're going to have monthly mortgage insurance. And that monthly mortgage insurance is based off 0.55%, which is going to be $114 a month. On top of that, you're going to have property insurance. I factor that in at 0.35%, which honestly, depending on where you are, might be higher, might be lower, but that's what we're using for today's videos. That equates to $70 per month. So your total mortgage payment with everything included would be $1,997 on a $250,000 home, which is more or less 47% of the debt to income ratio. So if you make $50,000 of income, then there's a chance that you could buy a $250,000 home, assuming you don't have a lot of other debts. We have to also assume that you have decent credit above 680 for today's example, because that's where we're getting these rates from. That tells us where we are today with a $250,000 purchase price using an interest rate of 6.75%. Now, I know $50,000 of income isn't going to be able to purchase a $300,000 home or a $350,000 home, but I did some different calculations showing different purchase prices using today's rates so that you can get an idea, which you can see here on the screen. But what happens in the case that interest rates continue to go up? Interest rates go to say 8%. How does that affect your affordability? How does that affect the monthly payment? Well, in this case, we're going to use a $250,000 home. Again, using the same calculations as we did before. The only difference that's going to change is the interest rate. And in this case, we're going to use 8%, which means your mortgage payment is going to go up to $1,791 per month. Now, everything else stays the same. The property taxes, the monthly insurance, the mortgage insurance, all that stays the same because the calculations don't change. They're all based off that purchase price, which means that if interest rates went up to 8%, your payment would go up to a total of $2,205, which means at $50,000 of income, you would no longer qualify for that $250,000 home. In fact, you'd be looking something closer to $225,000 because of how much it affects your affordability. In fact, you can see on the screen here where I put the same chart as we used at 6.75%, but using 8%, and you can see how much it affects the monthly payments. But what happens on the flip side if interest rates go down to 5%? How does that affect that $250,000 home? Well, once again, we're using the same calculations. The only thing that changes is the mortgage payment, which in this case drops $273 to $1,310. And while everything else stays the same, the property taxes, the mortgage insurance, the insurance, everything stays the same, again, because it's based off that purchase price, with the only difference being that you're saving nearly $275 a month because interest rates went down, which means that you'd be really, really close to being able to qualify for a $300,000 home if interest rates went down. And I realize some of these examples can be hard to see the real difference because we're talking about lower purchase prices. Where you start to see it is really in the higher purchase prices, how much these interest rates affect how much you can qualify for. In fact, I've put the charts up here at all of the rates that we've talked about, and you can kind of see the comparison on the bottom, but I did want to end with just a comparison using $600,000 with today's interest rates at 6.75%, and all the other calculations are the same, but essentially that breaks down to a $4,814 monthly payment. But if interest rates went up to say 8%, that means you're paying nearly $502 more per month at a mortgage payment of $5,316. But on the flip side, if interest rates were to go down to say 5%, you'd be saving $658 per month on that $600,000 home. And you can see exactly why, as interest rates come down, home prices typically go up because more people now qualify for that home, and in turn creates more buyer demand, more competition, essentially driving those prices up. So instead of trying to pick the top or the bottom in the market and wondering, what's right for you, just make sure you're buying for the right reasons. Make sure you're staying educated. You're not only watching my channel, but you're watching other channels to educate you. If you're a first-time home buyer and you're just starting the process, I actually created a first-time home buyer course to guide you through this entire process from A to Z to really help you become that expert in the market. So if you're interested at all, do me a favor and check that link below. Now understand the calculations today were done with FHA. Conventional financing, you're going to have a similar result, right? As interest rates go up, it's going to affect how much you can afford. And if interest rates go down, it's going to allow you to purchase a little bit more home. Now, earlier in the video, I mentioned I did this video because I had put out a video seeing how much you could afford between $50,000 and $75,000 of income and how it got a lot of views. And so I thought I would build off of that and try to give you some more information using today's rates. Well, if you want to go back and check out that video and see where payments were at 5.75% and also learn more about FHA, do me a favor and check out that video here.